the surface-level prosperity of the U.S. economy, evidenced by stock indices hitting new highs, belies a more complex and worrisome reality. Job growth is stalling, critical manufacturing and services indices are declining, and GDP indicators are weakening. Beneath this facade, the corporate sector is experiencing an alarming surge in bankruptcies, driven by high interest rates and waning consumer spending. Even Federal Reserve Chairman Jerome Powell has voiced concerns about the long-term implications of sustained high interest rates on economic growth. As the economy teeters on the edge, the question looms, will the Federal Reserve lower rates in September to stave off further economic distress? As we delve deeper into the current economic landscape, it becomes evident that the indicators are mixed and the stakes are high. With corporate bankruptcies on the rise and consumer spending slowing, the potential for a major market correction is significant. What steps should the Federal Reserve take to navigate these turbulent waters, and can a balance be struck to ensure a soft landing for the U.S. economy? Are high rates endangering the U.S. economy? Economic growth and employment concerns. While U.S. stock indices might suggest a thriving economy, the underlying data tells a different story. Growth rates are slowing, and this slowdown is reflected in the job market. In a recent report, job creation in the U.S. was recorded at 150,000, falling short of the expected 165,000. This discrepancy signals that the labor market might be losing momentum, which could have broader implications for economic stability. Declining manufacturing and services indices. The Institute for Supply Management, ISM, has reported that both manufacturing and services indices have fallen below the critical threshold of 50. A reading below 50 typically indicates contraction, and these declines suggest that key sectors of the economy are struggling. Additionally, the Atlanta Federal Reserve's GDP indicators have shown a downward trend, reinforcing concerns about the overall health of the economy. Surge in corporate bankruptcies. One of the most pressing and alarming issues is the increase in corporate bankruptcies, which has not yet garnered widespread attention. According to S&P Global, June witnessed a historic spike in U.S. corporate bankruptcy filings, with 75 filings, the highest number recorded in a single month since the early 2020s. So far in 2024, there have been 346 bankruptcy filings, exceeding any comparable figure over the past 13 years. This trend is largely attributed to the high interest rates that have strained corporate finances and reduced consumer spending. The consumer discretionary sector, which includes non-essential goods and services, has been particularly hard hit. In 2024 alone, there have been 55 bankruptcy filings in this sector, with 16 occurring in June. This surge indicates that businesses relying on discretionary spending are struggling as consumers tighten their belts. Federal Reserve's dilemma. Federal Reserve Chairman Jerome Powell has expressed concerns that maintaining high interest rates for an extended period could jeopardize economic growth. The central bank faces a challenging decision: lower rates to stimulate the economy or keep them high to control inflation. As the economy slows, inflation is gradually nearing the Fed's 2% target. However, there is apprehension that easing monetary policy too soon could hinder efforts to achieve long-term stability. Stock market implication. The ratio of U.S. growth stocks to value stocks has reached its highest point since the dot-com bubble, highlighting a potential imbalance in the market. The technology sector's dominance in the S&P 500 index has led to predictions of a significant market correction. Some analysts forecast a drop of around 10% in the coming months, which could have widespread implications for investors. Bond, stock, and gold trends. Interestingly, the current economic environment has been favorable for bonds, stocks, and gold. Despite the bad economic news, these assets have seen increased interest as investors seek safe havens. However, this trend also underscores the growing distance from a soft landing, where the economy slows without entering a recession. Earnings season outlook. The upcoming earnings season is poised to provide further insights into the state of the economy. Reports from major banks like Wells Fargo, J.P. Morgan, and Citigroup could influence market sentiment. Scott Rubner of Goldman Sachs Group Inc. has cautioned that a disappointing earnings season could lead to a painful period for the market. As we assess the current economic landscape, it becomes clear that the U.S. is at a critical juncture. High interest rates, slowing job growth, declining manufacturing and services indices, and a surge in corporate bankruptcies paint a concerning picture. The Federal Reserve faces a delicate balancing act: how to support economic growth while keeping inflation in check. The upcoming months will be crucial in determining whether a soft landing is achievable or if the economy is heading toward more turbulent times. What do you think should be the Federal Reserve's next move to navigate these challenges effectively? Share your thoughts on how the U.S. can best manage these economic pressures.